Bitcoin faces Japan rate hike, debunking the yen carry trade. Unwind alarms. The real risk elsewhere. What to know? The impending Bank of Japan rate hike is largely priced in. Japanese bond yields near multi-decade highs. Speculators maintain net bullish positions in the yen, limiting the scope for sudden yen strength. The Bank of Japan tightening may contribute to sustained upward pressure on global yields, impacting risk sentiment. The Bank of Japan is going to be raising rates this week, guys, is what that first paragraph was telling us about. The Bank of Japan is expected to hike rates next week. Some observers are worried that the Japanese yen could surge, triggering an unwinding of carry trades, crushing Bitcoin. Their analysis, however, overlooks actual positioning in the FX and the bond markets, missing the nuisance and far more likely risk that Japanese yields by anchoring and potentially lifting global bond yields could eventually weigh over risk assets rather than the yen itself. The popular yen carry trades. Before diving deeper, let's break it down. The yen carry trade and its influence on the global markets over the past few decades. The yen carry trade involves investors borrowing Japanese yen at low interest rates in Japan and investing that money in high yielding assets. For decades, Japan kept interest rates near zero, prompting traders to borrow in yen and invest in US tech stocks and treasury bonds. As Charles Schwab noted, going long on tech and short on the yen were two popular trades because for many years the yen had been the cheapest major funding currency and tech was consistently profitable. For many years, Japan kept interest rates low, and people were borrowing from Japan, guys. Basically, what they say, and putting their money into tech stocks and Bitcoin and everything that pays a higher rate. So basically, it's like an arbitrage. You borrow in Japan, invest in the US. With the Bank of Japan expected to raise rates, concerns are rising that the yen will lose its cheap funding status, making carry trades less attractive. Higher Japanese interest rates and Japanese government bond yields, along with strengthening yen, could trigger carry trade unwinds. Japanese capital repatriating from overseas assets and sparking broad risk aversion, including in BTC, as witnessed in August 2025, debunking the scare. This analysis, however, lacks nuisance on several levels. First and foremost, Japanese rates, even after the expected hike, would sit at just 0.75% versus 3.75% in the US. The yield differential would still remain wide enough to favor US assets and discourage mass unwinding of carry trades. In other words, the Bank of Japan will remain the most dovish of major central banks. Secondly, the impending Bank of Japan rate hike is hardly unexpected and it is already priced in, as evidenced by the Japanese government bond yields hovering near multi-decade highs. The benchmark 10-year Japanese government bond yield currently stands at 1.95%. Damn, guys, that's very low. You can literally borrow in Japan, guys, for 10 years and pay 1.95%. Imagine. And then invest that money in South African government bonds, which are paying anything from like 5 and 7%. So, yeah. This disconnect between bond yields and policy rate suggests market expectations. It has been in forward markets for more than a year, and investors have already repositioned for Bank of Japan's normalization since 2023. The bullish yen positioning. Lastly, speculators' net long yen positions leave little room for panic buying post-rate hike, and even less reason for carry trade unwinds. Data tracked by investing.com shows that speculators net positioning has been consistently bullish on the yen since February this year. This starkly contrasts with mid-2024, when speculators were bearish on the yen. That likely triggered panic buying of the yen when the Bank of Japan raised rates from 0.25 to 0.5% on July 31st, 2024, leading to the unwinding of carry trades and losses in stocks and cryptocurrencies. Another notable difference back then was that the 10-year yield was on the verge of breaking above 1% for the first time in decades, which has likely triggered a shock adjustment. That's no longer the case, though, as yields have been above 1% and rising for months. The yen's role as a risk-on, risk-off barometer has come under question recently, with the Swiss franc emerging as a rival, offering relatively lower rates and reduced volatility. To conclude, the expected Bank of Japan rate hike could trigger volatility, but it's unlikely to be anything that was seen in August 2025. Investors have already positioned for tightening, as Schwab noted, and adjustments to the Bank of Japan tightening are likely to happen gradually and are already partially underway. What could go wrong? Other things being equal, the real risk lies in Japanese tightening, sustaining elevated US Treasury yields, countering the impact of expected Fed rate hikes. This dynamic could dampen global risk appetite as persistently high yields raise borrowing costs and weigh on asset valuations, including those of cryptocurrencies and equities. Rather than a sudden yen surge unwinding carry trades, watch the Bank of Japan's broader global market impact. Another macro risk, President Trump's push for global fiscal expansion, which could stoke debt fears, lift bond yields, and trigger risk aversion. So there you have it, guys. That's basically what we can expect this week.